Assalamualaikum warahmatullahi wabarakatuh. Today we're going to talk about market for foreign exchange. We are from Group 6 and we consist of 5 group members. Let me introduce our group members. The first one is Muhammad Alif Daniel, second one is Muhammad Zarif, the third one is Muhammad Sufia Azwar, the fourth one is Muhammad Zaki, and lastly is me, Muhammad Ridwan. Let me begin with a brief introduction. The foreign exchange market, often referred to as forex market or FX market, is an over-the-counter global marketplace that determines the exchange rate for currencies around the world. It is essential for international transactions in goods, services, and financial assets. It is the largest financial market in the world, with a daily trading volume exceeding trillions of dollars.
Hi. Assalamualaikum warahmatullahi wabarakatuh. So my name is Muhammad Zarif Badurrahim. So today I'm going to present to you guys about the participant in the foreign exchange market. So we got a lot of participants in the foreign exchange market. So let's break it down to the participant, and later on I will mention it about the roles of motivation for the each participant. So let's continue to our discussion. Alright, the participant in the foreign exchange market. So we have 5 of it, which is central bank, commercial bank, investment firm, corporation, and governments. Now, I'm about to talk the roles of the motivation for each participant, including that I mentioned above just now. Alright, firstly, central bank. It is responsible to implement the monetary policy to maintain their stable of exchange rate. So moving on to the second part of it, commercial bank. The most active participant for trading account, which can earning a profit. So next, the third one is investment firm to engage in the forex trading to make a profit for their client. Right, besides that, we have a corporation, the number 4. It is a multinational firm manage their currency risk on the foreign market. And last but not least is government to control the value of the national currency to stabilize their own economies. So that is the 5 of the participant in the foreign exchange market. So moving on to the next part of it.
Hi, my name is Muhammad Zaki. Today I want to present about key concept. So they have a 4 point about key concept. The first one is exchange rate. Exchange rate is the price which only currency can be exchanged for another currency. So they have a 2 point about exchange rate. First one is spot rate. Spot rate is exchange rate at which currency at the exchange immediately or by today you exchange your rates. For the second one is forward rate. Forward rate is exchange rate for currency transaction that will happen at the specific future date, meaning you want to transaction your currency about 3 months from today. That is different between these two, spot rate and forward rate. So another next point is currency pair. Currency pair is considered by two currency. The first currency is called by currency and the second one is quarters currency. For example, 1 euro equal to 1.11 USD. That's meaning euro is the best currency and USD is quarter currency. The third point of the key concept is a bid and ask price. The higher price a buyer will pay and the lower price a seller will accept. The difference between the two price is called by spread. And the fourth point of the key concept is currency application and depreciation. When the currency increase the value relate to another currency is calling by currency application. Meanwhile, the currency depreciation happen when a currency lose a value relative to other currency. So that's all for me. I will pass to the next presenter. Thank you.
Assalamualaikum. My name is Muhammad Lidin bin Mazlan. So I will be explaining about factor affecting the exchange rate. There are three factors that affecting exchange rate. First is the economic indicator. Second one is political event, speculation, and market sentiment. One of the primary factors that influencing exchange rate is the economic indicators. The GDP of a country plays a significant role, as a growing economy often attracts foreign investment, leading to an appreciation of the currency. Conversely, a declining economy may cause investors to sell the country's currency, resulting in depreciation. In that also, inflation also affect the exchange rate. Inflation can erode the purchasing power of a currency, making it less attractive to investors. This can lead to depreciation. On the other hand, low inflation can make a currency more attractive, potentially leading to appreciation. Lastly, in the economic indicators which is interest rates are another important factors. Higher interest rate can attract foreign investors seeking higher returns, leading to an appreciation of the currency. Conversely, a lower interest rate may cause investors to withdraw their funds, resulting in depreciation. Next is the political event. Political event can have a significant impact on the exchange rate. Government policies such as trade agreements, fiscal policy, and monetary policy can influence the value of a currency. For example, a country with a trade surplus may see its currency appreciate due to increased demand for its exports. Political stability is also crucial. Political uncertainty can deter foreign investment, leading to depreciation. Example of political instability include political unrest, election, and change in government. Geopolitical events such as wars, natural disasters, and trade disputes can also affect exchange rate. This event can create uncertainty and disrupt economic activity, leading to fluctuation in currency values. Lastly is speculation and market sentiment. Investor sentiment and speculation can play a significant role in driving exchange rate movement. Herd behavior and market psychology can cause currency to overreact to news and events. Currency traders often use technical analysis and fundamental analysis to make prediction. Currency trading itself can also influence exchange rate. Large-scale currency trading by institution and individual can create significant fluctuation in currency values. So that's all from me. Thank you.
Okay, now let's moving on to the role of the central bank, which is intervention in the foreign exchange market. So I already provide 4 points for this part, which is the first point is to maintain the exchange rate stability. Then this could be to prevent excessive fluctuation that could harm domestic business and consumer. And for the second point is manage inflations. By influencing the exchange rates, a central bank can impact import prices, which can affect domestic inflation rates. And for the third point is support economic growth, which is a weaker exchange rate can make export more competitive, boosting economic growth. And last but not least is respond to crisis. During financial crisis, central banks may intervene to prevent a sharp depreciations for their currency. Okay, now let's moving on for the tools of interventions. For this part, I already provide 4 points, which is the first point is open market operations. So the open market operation, they have a buying or selling government bonds, which is by buying or selling government bonds, central bank can increase or decrease the money supplies. And the second point is sterilized interventions, which is in sterilized interventions, central banks simultaneously buy or sell foreign currency and domestic assets to maintain the domestic money supply. And then next is a foreign exchange reserve. So for the first one is buying or selling foreign currency. For the central banks can use their foreign exchange rate reserves to buy or sell foreign currency, directly influencing the exchange rates. And next is currency swap, which is the central bank can enter into currency swap agreements with other central banks to exchange their currency for a specified period. And then next is interest rate policy, which is they have adjusting interest rates. For this part is by raising or lowering interest rates, the central bank can influence the attractiveness of their currency to foreign investors. And then for the last part is capital control, which is they have a restricting capital flow. So in some cases,
To conclude about our topic today, which is market for foreign exchange, the foreign exchange market is a complex and interconnected system that plays a crucial role in global trade and finance. Factors such as economic indicators, political events, and speculation and market sentiment can significantly impact exchange rates. By understanding these key determinants, businesses and investors can make informed decisions and manage currency risk effectively. Let us commit to staying informed about the foreign exchange market and its dynamics to ensure our financial success in a globalized world. Don't forget to like this video and leave a comment below. Thank you for watching.